In this video, I'll be reviewing a Wall Street Journal investigation that uncovered that executives and early investors at companies that IPO'd via SPACs made billions before the SPAC bust. The SPAC bust that hurt investors like you and I. The purpose of this video, like with any video I've done about sort of these scammery type of situations, is to help us avoid them. Because the best way for us to do better than the average investor over a long period of time is to avoid the things that cause you to do worse than average. And nothing will do that better than getting caught up in something like a SPAC or any situation where there's a very low probability of success. So with that being said, I appreciate you for joining me. Let's get into this video. I think you'll learn something. There's actionable takeaways at the end. And overall, I think it's an important story to pay attention to. So I also do an impression of Chamath. So, hey there. Well, here's the thing, Scott. Here's the thing. All right, let's get to it. Greetings from New York City. This is Chris Franco. Thank you for tuning in to CMQ Investing. This is a channel where we focus on how to build long-term wealth and actually do that in some really simple ways. And one of these ways is to avoid, well, how do I say it? Stupidity, scumbags. It might sound kind of funny, like it's, well, that sounds pretty good. But actually, it's easier said than done because there are so many ways for us as investors to get our money caught up with something that's really, well, most likely not going to end with a positive result. And something that I saw as it was happening, I talked about this on the CMQ Investing podcast, which, by the way, was in the top 1% of most shared and most followed podcasts across all podcasts on Spotify in 2022. So I'll put a link in the description if you want to check that out if you're looking for more content. If not, though, I've got plenty to say about this right here. But anyway, with basically these SPACs were set up to lure in retail investors, pump up the price of something, and then the insiders in those companies, and I'm not making any legal accusations here, I'm just calling it how I saw it, were able to make off like bandits. And really who made out like a bandit was Chamath Palihapitiya. I always say his name wrong. It's not worth correcting because he's not a nice guy. But the point is, that is an individual who will come up in this conversation because the Wall Street Journal has just released a story making some pretty bold accusations about insider trading at a lot of these companies that had SPACs. So I'm going to read through this with you, share my thoughts, and hopefully leave us with some actionable takeaways that we can use to our advantage as long-term investors. So if you like how that sounds, please make sure to hit the thumbs up, like the video, leave a comment, subscribe. I appreciate it very much. We're really trying to do some really good stuff here. So I'll let you be the judge on how this video comes out. Let's get to it. So starting things off, I'm going to read through this article. It's not very long, but I'll be, interjecting with some context as well. It says that the SPAC boom cost investors, that's us, billions of dollars. But insiders in the companies that went public were on the other side of the trade. Executives and early investors in companies that went public via SPACs sold shares worth of $22 billion through well-timed trades. Well-timed. Remember, you can't time the market. Profiting before share prices collapsed. Some of the biggest winners were the Detroit Pistons owner Tom Gores, who, by the way, I'm a Pistons fan, lifelong. I don't know anything about Tom Gores, but sorry to hear that he's being thrown into this mix, and the Pistons name is thrown in this mix. His private equity firm, his investment firm Platinum Equity was a big winner. So was Richard Branson. And then the convicted Nikola founder, Trevor Milton, who that's a whole talk about a fraud and a scam artist. Anyway, they were among many insiders who got these shares on the cheap and then sold them as they rose in value. This is according to a Wall Street Journal analysis of insider trading disclosures associated with more than 200 companies that did SPAC deals. And I want to say, by the way, look, this guy's, what a look. It's a nice head of hair. I'm envious. Oh my God. Take my hat off and cry. I'm bringing this up because, well, I interacted with individuals through Instagram Live. By the way, Charlie Munger Quotes is an Instagram account that I made during the pandemic that kind of started all this stuff. Anyway, I go live on there, and I remember there was a guy, I forget, I wish I could remember exactly his name, but I believe he was a college student in Texas, and he was telling me how he got swept up in this whole SPAC momentum hype, primarily because he thought Chamath was looking out for him. And that's really what bugs me is just, it's not like anyone couldn't have made these mistakes. It's just that they prey on people who, are going to make their first big financial mistake. And I just don't respect that at all. But Chamath would be like, well, here's the thing. It doesn't, here's the thing, Franco. It doesn't matter what you think because, it's Don't trust anybody that takes the bass out of their voice and talks with an upward inflection. It's usually they're trying to scam you. They're trying to seem like a nice guy. To continue this, though, companies that went public this way have lost more than $100 billion in market value. At least 12 have filed for bankruptcy, and more than 100 are running low on cash. And they're being battered by something that everyone's dealing with, and that's higher interest rates and rising costs. Many executives claimed during the boom that SPAC mergers were a better way for companies to go public than traditional initial public offerings. Something to keep in mind here is incentive cost bias. Of course they're going to say that. It's easy to understand why executives at the companies went with this option, said New York University Law School professor Michael O'Rourke, who studies SPACs. It wasn't because it was a better financial technology, it was because it was just better for them. Amen. The journal analyzed more than 460 companies. By the way, this is why I subscribe to the Wall Street Journal. I have a paid subscription. I am not endorsed by them or anything, but I highly recommend it. It's money well spent. The journal analyzed more than 460 companies that did SPAC deals and identified 232 with insider sales based on a review of the SEC's filings submitted through May 18th. So let's just recap there. 232 out of 460. Okay, so that's more than 50%. More than 50%, apparently, had insider sales through May 18th. So that's pretty significant. The analysis focused on disclosures made by investors who own more than 10% of a company and corporate officers and directors. Of those with sales, insiders at 12 companies cumulatively sold shares worth at least $500 million. Not bad. Insiders at about 80% of the 232 companies sold shares valued at less than $100 million, the journal's analysis shows, and on average, investors sold about $22 million worth of shares each. One of the biggest paydays went to Platinum Equity. That's the one that's owned by the Pistons owner. The private equity firm sold shares of 4 companies that it had invested in before they went public via SPAC deals, generating some $2.3 billion in proceeds. Platinum's biggest haul came from selling the stock of Vertiv Holdings, a vendor of data center infrastructure. Great. Going to go a little bit farther down here. As they were selling stock in 2021 for between $20 and $25 a share, 5 pension funds were buying. Oof. In February 2022, Vertiv's share price fell 37% on a single day to $12.38 after the company announced disappointing financial results that one Deutsche Bank analyst described as shockingly bad. The pension funds collectively lost nearly $2.4 million, which is, again, that's people's retirement. The pensions filed a lawsuit last year alleging Vertiv's management issued misleading earnings guidance. Most of the pension's losses were realized by the Louisiana Sheriff's Pension and Relief Fund, which spent more than $2.6 million on shares and eventually sold about half of those holdings at a loss, court records show. Okay, not gonna, again, these are all just, it's all in court. I'm not saying this is, fact or Vertiv is all bad. I'm just reading the article. But spokesperson for Vertiv said they strongly disagree with the premise of the lawsuit. They also went on to say that, let me see here. Yeah, let's see. Vertiv shares now trade at around $20, down from an all-time high of more than $28 in 2021, but still above the SPAC's original $10 listing price. That is not the case for many other companies that saw sizable insider selling, including space tourism company Virgin Galactic. Man, you don't hear much about them going to space anymore, do you? Branson, the company's founder, sold nearly 75% of his shares for more than $1.4 billion before launch delays and high costs sent the stock down more than 90% from its all-time high, and about 60% below the SPAC's listing price. The proceeds of Branson's sales were used to shore up his Virgin Group, whose travel and leisure businesses were battered by the pandemic, a spokeswoman said. Branson is still Virgin Galactic's largest shareholder. Now, look, I'm not just reading that at face value. He needed capital for another part of his business. I don't know if he did anything to manipulate the price. I'm not even going there mentally, but I'm just saying, he's still the largest shareholder, and he used the money to help shore up a part of his business that was suffering from the pandemic. Doesn't seem terrible to me. That's just me. Meanwhile, speaking of terrible, hey everybody, it's me, Chamath. Venture capitalist Chamath Palihapitiya, head of the SPAC that took Virgin Galactic public, who, by the way, was like, hey Scott, this is a great company. You got to get in on this stuff. Young people get it, Scott. Remember him on CNBC talking like that? Well, if you don't, well, maybe another time we'll talk about it. But he made $310 million from selling shares of the company. And this is a company that he's not promoting about how great it is. It's the greatest thing ever. He also spent another $144 million to purchase shares and exercise options. The former Facebook executive became, by the way, one of the reasons Chamath bothers me is because he's from the world that I'm from, growth marketing. It's like one of my own, but he's not someone who comes across like I really would trust him with anything. But it says that the former Facebook executive became known as the SPAC King for the hundreds of millions he made during the boom across deals like Virgin Galactic and personal finance app SoFi, which I've talked about in other videos. A spokesman for Palpatia declined to comment. It says that SPAC executives receive ultra cheap shares for taking companies public that increase their returns. It's, in my view, and this is just my view, not a factual statement, just my personal opinion. It's a bona fide pump and dump, right? You get someone to go out here and talk about how great this company is without having to show the same kind of transparency you'd have to if it was a publicly traded company. They can kind of make all these sorts of bold claims if they get lots of media attention. And then they lure a lot of people in who, just like any human being, is looking for easy ways to get rich. That's one of the easiest value propositions to have as a marketer ever. Hey, you want to make a lot of money really easily, really quickly? And that's what these SPACs were positioned as. Like, this company is going to change the world. And then what a guy like Chamath would do in some instances is he'd get everyone excited, people buy in, the price goes up, then he gets out. After he just told you it's like the greatest company to ever own, but he sold out. Anyway, I just don't respect it. It says here that the also called a blank check company, a SPAC is a shell firm that lists publicly with the sole intent of merging with a company to take it public. After regulators, it's been a minute. After regulators approve the deal, the company going public replaces the SPAC in the stock market. Insiders made more than $200 million at many other startups that merged with SPACs, including fuel cell truck upstart Nikola, self-driving car technology maker Luminar Technologies, and online gaming company Skills. Much of Nico's roughly $450 million in share sales went to founder Trevor Milton, who resigned from the company amid allegations of fraud in September 2020. I feel like I've made a video about that, or I made one, I didn't publish it, but yeah, talk about just unbelievable scammery. Like the gall of that guy. The next year, Milton sold about $374 million worth of stock for a weighted average price of about $11. He was convicted of securities fraud last October, and shares have since dropped below $1. Luminar is led by 28-year-old chief executive Austin Russell, who recently led a bid to acquire business media outlet Forbes. It went public through a SPAC backed by private equity billionaire Alec Gores, the brother of Platinum Equities, Tom Gores. Interesting. Russell took in $220 million, selling some of his Luminar shares in July of 2021 at $21 per share. The sale was to institutional investors in a private placement. And on Friday, this past Friday, Luminar shares sold at under $7 per share. Russell also paid $31 million to buy shares in 2022 and 2023 at an average cost of $6.81 per share, and his compensation is tied to the stock's performance. A little bit left here, and we'll wrap it up. Two of Alec Gore's SPACs took companies owned by his brothers Platinum Equity public, and the Gores brothers recused themselves from negotiations. Insiders have made about $700 million in sales from one of these companies, Vera Mobility, a technology provider for fleet management, which, by the way, that's a whole interesting sector to look into. It's if you're not actively thinking about, fleet, trucking and how we get, our goods from one place to another, it's a pretty interesting space. Tom Gores' Platinum Equity accounted for most of those sales, and Vera is another rare case where the stock has risen after its SPAC deal. So again, it's not the norm. These company owners were aware the valuation that the SPAC was giving them was exceptionally generous. The professor from NYU said it's a no-brainer to take advantage of that. So that's the thing. I mean, in many cases, I don't know if there's anything illegal that's happening. It's just gross. It's gross because you're preying on, in my view, from where I'm sitting, you're preying on people who are younger, 20-ish. I mean, 20s, not 20-ish, but in their 20s generally. I'm 35. When I was 25, I would have been easily led into a SPAC. It just seemed like it makes sense when you don't know certain pieces of information, or you just haven't, I can't describe it exactly. It's just there's something about investing your money where you can think you know a lot and actually know nothing. And there are people out there who will prey on that. And I think that's something I want to continue to use this platform as we grow it together. And I hope you'll subscribe, by the way. But I hope we can, identify some of these, I won't call them bad actors, but actors that have a track record of bad results for investors, as well as some of the patterns just to avoid and understand why this would be something avoidable. For me, if you want to avoid a SPAC, a little actionable takeaway here, or avoid something like a SPAC, is whoever's promoting anything to you, make sure you find out what their incentives are. Like the Charlie Munger quote, show me the incentives and I'll show you the outcome. That's a good example or a good way to think about this. And I think for anything, when anyone's interested in getting you to put your money into anything, make sure you know what their incentives are and ask yourself, is this aligned with my incentive? And if not, why? Or if so, why? Really scrutinize it. Think critically. It doesn't take a ton of time. It's just something you got to kind of, get yourself in the habit of doing all the time. And I think you'll avoid a lot of trouble. So with that being said, my name is Chris Franco. This is CMQ Investing. I appreciate you for watching the video and tuning in. Hope you'll like this. Give it a thumbs up, subscribe, follow, whatever other options there are. Please do that. I really appreciate all the engagement, and I will talk to you soon. Later.